Wall Street is still unnerved, stoking fears through the benchmark stock indexes managed to gain some ground on Monday. Rising yields of the US Treasuries and the rally of the US dollar is breaking all minor signs of the risk appetite. The new trading day promises a new challenge. Despite yesterday's growth, Wall Street indexes managed to regain some losses. The Dow Jones climbed by 0.13%, the Nasdaq recovered by 0.45%, and the S&P 500 grew by 0.4% to close at 4,337 points. Nevertheless, the pre-market on Tuesday dampened the upside of the previous session. Futures on the major stock indexes traded under pressure and went down before the opening bell. The S&P 500 is expected to trade in the intraday corridor between 4,270 and 4,340. The benchmark stock indexes closed in the green yesterday, triggered by Amazon shares and the energy sector. The S&P 500 recovered after its steepest slump last week since March. As of Monday, the index tumbled by about 5.5% since late July. However, it's still 13% up in 2023. The head-edge of the stock market is rising yields of US Treasuries, which jumped to the highest level in 16 years, after the US Fed gave the hawkish forecast for long-term interest rates. Fed policymakers are in no hurry to give a hope to investors. Minneapolis Fed President Neil Kashkari said that further rate hikes would likely be needed because of the surprising strength of the US economy. If the economy is fundamentally much stronger than we thought, then that tells me that interest rates may have to be raised a little bit and then held higher for longer to cool things down, Kashkari said. Chicago Fed President Austin Colsby said in an interview with CNBC on Monday that keeping inflation above the Fed's 2% target remains a bigger risk than the central bank's tight policy stance and the hard landing. The concern about the US national debt is worsened by efforts made this week by the Republican-controlled House of Representatives to pass debt spending cuts that have no chance of becoming law but could trigger a partial government shutdown by next Sunday. Hundreds of thousands of federal workers could be laid off and government services suspended if Congress fails to fund the new fiscal year starting from October 1. Ratings agency Moody's said on Monday that the US government shutdown would harm the country's creditworthiness. And the warning came a month after Fitch downgraded the US rating by one notch amid the debt ceiling crisis. In corporate news, Amazon shares rose by 1.7% after the e-commerce giant said it would invest up to $4 billion in startup Anthropic to compete with the rising cloud-based artificial intelligence rivals. On Tuesday, the pessimistic mood of the American stock market worsened and the battle of market favorites intensified. Futures on the US stock indexes went down, and the reason are the same: Fed policy, rising Treasury yields, and the government shutdown. Private sector bankers are starting to brace for the worst, with the JP Morgan chief Jamie Dimon warning last night. I'm not sure if the world is ready for 7% Fed rates. Meanwhile, a report from Goldman Sachs showed hedge funds increased their bearish bets mostly on the US stocks last week, with the clients adding short positions and unloading long positions. Consumer, industrial and financial companies accounted for massive sell-offs. In this context, mega-cap growth stocks including Apple, Microsoft, Meta and Tesla lost between 0.5 and 1.3% in a pre-market trading. Amazon.com shares also fell by 0.5% after Wall Street backed its plans to invest in a high-profile startup Anthropic on a Monday. As for events that could affect market sentiment, today most of the reports will be released after the opening bell. A nationwide consumer confidence report is the highlight of the economic calendar today. Besides, investors will have to evaluate new home sales in the United States in August, home prices in July, and the Richmond Fed business survey for September, and surveys of the Dallas and Philadelphia Feds. Michelle Bowman is due to speak later today as well. The US dollar index touched the highest level in 10 months but retraced downward shortly after. The instrument was trading steadily at about 106 points before the opening bell. The intraday CAD for the index is seen between 105.70 and 106.20. The US dollar index grew by 0.2% to trade at 106.20, the strongest level since November 2022. The Canadian dollar is also weakening against its firm American rival. The USD CAD pair remains at around 1.3490. The instrument is expected to trade in the intraday CAD between 1.3460 and 1.3520. Oil prices always provide the loonie with the support, and today crude oil is trading mixed. The reason behind the bearish trend is that investors are worried that oil demand will be tight because global central banks will keep interest rates at elevated levels for longer than expected. The American Petroleum Institute is due to release a weekly update on the U.S. oil inventories later today. Analysts predict a decline of 1.7 million barrels for the week ended on September 22. The crypto market is trading sideways without a clear-cut trend. Bitcoin inched down at midday, and the token traded at $26,230 in the early New York session, 0.23% down. The intraday CAD for the flagship crypto is determined between $26,000 and $26,400. Going beyond the borders could push the price down to $25,650 or up to $26,600. The cryptocurrency market reflects a general confusion about risk, with a few bright spots in the domestic market. The U.S. Securities and Exchange Commission on a Monday opposed Celsius Network's proposal to bring in a Coinbase as a part of its bankruptcy and reorganization plan. Last week, Celsius announced plans to use Coinbase to distribute digital assets to its international clients, and the company needed a court approval, but the Commission filed documents objecting to the crypto firm's plan, and the news had little impact on investor sentiment. Make profits with the InstaForex no matter what trend is unfolding. Our team of analysts is eager to provide you with the relevant information and answer all your questions. So see you online tomorrow.